Four companies control roughly 3/4 of the largest financial market most Australians will ever touch: the mortgage on their own home. As of March 2026, the Commonwealth Bank alone holds 25.4% of Australia's $2.46 trillion home loan market. Add Westpac's 20.7%, NAB's 14.1%, and ANZ's 13.2%. And four institutions control roughly 73% of every dollar borrowed to buy a house in this country. In business lending, the concentration is even tighter. The same four banks hold just over 70% of all lending to non-financial businesses in Australia. Here's the part that should genuinely surprise you. This isn't an accident of market competition. It isn't four companies that simply outcompeted everyone else through better products or lower prices, the way a monopoly usually forms. It is the direct, intended outcome of an actual government policy, one that has never been passed as a law, was never voted on by Parliament, and yet has shaped who controls Australian credit for 36 years. It's called the Four Pillars Policy, and it works by doing something almost no other developed economy does openly. It tells the four largest banks in the country that no matter how big they get, they are explicitly forbidden from ever merging with each other. This is the story of how a one-page policy statement from a treasurer in 1990 built one of the most profitable, protected banking sectors on Earth. And why, depending on who you ask, that's either the reason Australia sailed through the 2008 financial crisis almost untouched, or the reason Australians pay some of the highest banking margins in the developed world. To understand why the Four Pillars Policy exists, you have to understand the chaos that preceded it. For most of the 20th century, Australian banking was a heavily regulated, almost sleepy industry. Interest rates on deposits and loans were largely set by regulation rather than competition. Banks needed government approval for basically everything: how much they could lend, what rates they could charge, even how many branches they could open. That started to unravel in the 1980s. The same wave of financial deregulation that floated the Australian dollar in December 1983 also tore down the walls protecting the banking sector. Foreign banks were licensed to operate in Australia for the first time in 1985. Interest rate controls were abolished. Suddenly, Australian banks were exposed to real competition and real risk in a way they'd never experienced. The result, through the mid to late 1980s, was a wave of aggressive expansion and, in several cases, near disaster. State government-owned banks in particular went on reckless lending sprees during the decade's property and business boom. When the boom turned to bust at the end of the 1980s, the damage was severe. The State Bank of Victoria collapsed under bad debts and was absorbed by the Commonwealth Bank in 1990. The State Bank of South Australia effectively failed the same year. Westpac itself came dangerously close to insolvency in 1992, after a wave of bad commercial loans, and only survived through a major capital raising. This was the backdrop entering the 1990s, a newly deregulated banking sector that had just proven it could genuinely blow itself up, sitting inside an economy still recovering from a brutal early 1990s recession. It's against this backdrop, recent bank collapses, a fragile financial system, and a wave of merger proposals among the survivors looking to get bigger and safer, that the Four Pillars Policy was born. In 1990, the Australia and New Zealand Banking Group proposed a merger with one of the country's largest life insurers, National Mutual. Treasurer Paul Keating, the same figure who had floated the Australian dollar 7 years earlier, blocked it. But he didn't just block that one deal. He announced a broader principle: mergers among the four largest banks, the Commonwealth Bank, Westpac, NAB, and ANZ, and the two largest insurers, AMP and National Mutual, would not be approved. At the time, it was called the Six Pillars Policy. Keating's stated reasoning was straightforward. Australia's financial sector was small by global standards, and allowing its largest players to combine with each other risked concentrating power in the hands of one or two giants, undermining competition for everyday borrowers and depositors. This is a critical detail people consistently get wrong about how the policy actually works. The Four Pillars Policy has never stopped the Big Four from acquiring smaller competitors. It only blocks them from combining with each other. Over the following decade, the Big Four devoured the sector around them freely. The Commonwealth Bank acquired the State Bank of Victoria in 1990. then the State Bank of New South Wales indirectly through its later purchase of the Colonial Group in 2000. Westpac absorbed Challenge Bank and Bank of Melbourne through the 1990s. The pillars themselves never merged with each other, but everything smaller around them was fair game. In 1997, a major government-commissioned review of Australia's financial system, chaired by businessman Stan Wallace, recommended scrapping the Four Pillars policy entirely and subjecting the big banks to the same ordinary competition tests as any other business. The coalition treasurer at the time, Peter Costello, took a middle path. He removed the insurance companies from the policy, clearing the way for the sector's later insurance mergers, but explicitly kept the ban on mergers among the four banks themselves. That decision, made by a conservative pro-market treasurer against the explicit recommendation of his own government's review panel, is the moment the policy went from a specific Keating-era intervention to a bipartisan institution. Every government since, Labor and coalition alike, has kept it in place. The unofficial nature of this policy is itself remarkable. It has never been legislated. It exists as a standing statement of Treasurer's discretion, enforced through the government's power to approve or reject any acquisition of more than 15% of an Australian bank under the Financial Sector Shareholdings Act. In practice, this means four private companies operate knowing, with near total certainty, that their four biggest potential rivals for combination are permanently off the table. Not because of market forces, but because of one sentence of policy that a single treasurer can maintain or abandon at will. For nearly 2 decades, this arrangement quietly reshaped Australian banking without much public attention, until the 2008 global financial crisis turned the Four Pillars policy from a competition rule into what many now describe as an accidental financial stability shield. When Lehman Brothers collapsed in September 2008 and the global banking system seized up, the International Monetary Fund later singled out a small handful of countries whose banking sectors weathered the crisis with unusual resilience: Australia, Canada, India, and Malaysia among them. The common thread the IMF identified was that these banking systems were comparatively insulated from the toxic, internationally interconnected securitization markets that brought down banks in the United States and Europe. Australia's concentrated, heavily domestic four-pillar structure meant its major banks simply weren't as exposed to the exact instruments, collateralized debt obligations, complex mortgage securitizations, that triggered the global meltdown. In fact, Australia's biggest banks used the crisis to get bigger, not smaller. In 2008, with dozens of financial institutions worldwide teetering, the Commonwealth Bank acquired Bank West, at the time Australia's 6th largest bank, from its struggling British parent HBOS. In the same period, Westpac merged with St. George Bank, then the country's 5th largest lender. Both deals were approved despite significantly increasing concentration in a sector that was already among the most concentrated in the developed world. Because the Four Pillars policy, remember, only ever protected the four majors from merging with each other. It never protected competitors from being absorbed by them. This pattern has continued into the present decade. In 2022, ANZ agreed to acquire Suncorp's banking arm for $4.9 billion. Australia's competition regulator initially tried to block the deal on the grounds it would further entrench the Big Four's dominance, but the Australian Competition Tribunal overturned that decision in February 2024, reasoning that the deal's impact on overall market concentration would be too small to matter. The takeover completed later that year, pushing ANZ past NAB into 3rd place in the home loan market. Every time a mid-sized competitor to the Big Four falters or looks for an exit, the buyer is almost always one of the four pillars themselves. The result of 36 years of this dynamic is a banking sector, where the Big Four now collectively hold around $4.2 trillion in total assets, representing roughly 70% of the entire Australian banking system. Their combined mortgage book alone exceeds $1.6 trillion. So what does this concentration actually mean for the ordinary Australian household? The clearest evidence sits in the bank's own profitability. In the 12 months to mid-2025, Australia's Big Four banks posted a combined profit after tax of $29.8 billion, with an average return on equity of around 10.7%, comfortably above the global banking average, and achieved with remarkable consistency year after year, in sharp contrast to the far more volatile earnings of major banks in the United States, Europe, and Japan. Analysis from the Reserve Bank has repeatedly found that Australia's major banks have delivered persistently high, low volatility returns on equity compared with international peers across multiple decades. Precisely the kind of stable, oligopoly-like profitability that concentrated, protected markets are known to produce. The mechanism driving this is the net interest margin, the gap between what a bank pays depositors and what it charges borrowers. Australia's major banks have consistently maintained net interest margins in the range of 1.8 to just over 2%. A spread that, multiplied across trillions of dollars in loans, generates extraordinary profit at scale, even in years when margins look unremarkable on paper. Because mortgages make up such an outsized share of the loan book of Australian banks, one of the highest proportions of any developed banking system in the world, every movement in the Reserve Bank's cash rate flows almost directly into major bank profitability, since lending rates track the cash rate closely, while deposit rates are far slower and stickier to rise in response. Smaller banks and credit unions, meanwhile, structurally cannot compete on equal footing. They pay more to raise funding in wholesale markets. Since global investors treat the Big Four's implicit government backing, the widely understood assumption that Australia would never allow a major bank to fail, as a genuine credit advantage. This is sometimes called the too big to fail subsidy, an advantage the Big Four receive not because they manage risk better, but because the market assumes the government stands behind them. Challenger banks like Macquarie and a handful of digital lenders have grown faster in percentage terms in recent years, but from such a small base that none has meaningfully dented the Big Four's overall share. This is the genuine, unresolved tension at the center of the Four Pillars story, and it's worth stating plainly, rather than picking a side. On one hand, the policy has demonstrably contributed to one of the most stable banking systems among developed economies, a system that avoided a single major bank failure or government bailout during the worst global financial crisis in 80 years. On the other hand, that same stability has been purchased through deliberately reduced competition, and Australians have paid for it in the form of some of the highest, most consistent banking sector profit margins in the developed world, embedded quietly into every mortgage repayment, every business loan, and every savings account in the country. 36 years after Paul Keating scrawled out a policy to stop one merger between a bank and an insurer, the Four Pillars policy remains fully intact, upheld by every government since, regardless of party. It has never been legislated, never been put to a formal vote, and could technically be abandoned by a single treasurer's decision tomorrow morning. And yet it has proven to be one of the most durable, consequential pieces of economic policy in modern Australian history, quietly determining who controls the credit that underwrites nearly every home, every business loan, and every major financial decision in the country. Whether you view this as a prudent safeguard that protected Australian households from the kind of banking collapse that devastated economies overseas, or as a government-sanctioned oligopoly that has extracted decades of outsized profit from ordinary borrowers with limited alternative, the underlying fact remains the same either way. Four companies, protected by an unwritten rule rather than open competition, still decide the terms on which most Australians borrow money. That arrangement was built deliberately, in 1990, in response to a crisis of a very different kind, and it has outlasted every government, every review that recommended scrapping it, and every new challenger that has tried to break in since. If this changed how you look at your own mortgage or savings account, you're going to want to see how this same pattern shows up in Australia's tax system too. I've broken down exactly how a single 1985 policy reversal helped build the housing crisis you're living in right now. Links on screen and in the description. And if you want more of these deep dives into the systems quietly shaping Australian wealth, subscribe, because there's a lot more of this coming.